Chuck Hughes, I can hear you back there.
Yes, can you hear me?
Yeah, I have a picture of you right here.
Okay.
I want to say Happy Veterans Day to you
Oh, thank you.
yesterday.
Thank you.
Uh, give you some background on Chuck. Welcome, Chuck Hughes, to the room. Chuck is a retired, what was Air Force pilot, right?
Yes. Air
Okay.
Force and then airlines.
Okay. Have you seen the study that says the best profession for trading is an airline pilot?
I have not.
I'll have to dig it up and send it over to you.
Yeah, I'd like to see that.
Anyway, Chuck Hughes has been a partner of Metastock for a while now. He's a great trader, very successful running your optioneering team. How long have you been doing that?
Let's see. Trading for 32 years and teaching for 22 years. Okay, just let me know when you want me to start, Jeff. I know we had
Yeah, sorry about that. I'm going to get right out of
whole
the way.
system shut down.
Yeah. And I know why. Somebody's in trouble. I'm not saying who.
It wasn't
But I'll
me.
get out of your way. Yeah, no.
Okay.
All right, talk to you. Go. Your turn.
Okay. Okay, great. Thanks, Jeff. It's great to be here, everybody. Today we're going to talk about trading options with high returns and low risk. And I want to look especially at trading option spreads versus directional trades. When you buy a call option, the underlying stock must increase in price above the strike price of the option at expiration, or you'll lose 100% of the option premium. So that's what we're up against when we're trading options, is that the option will expire worthless. And we've developed a system over the years that helps mitigate that chance of 100% loss when you're trading options, and I'll show you how we do that. And just to give you an idea, I took this screenshot recently. This was Facebook stock, and it's a option. It's an option pricing schedule here, and at the time Facebook was trading at 132. So let's say we're going to buy the 135 strike call option. It was trading for 310 bid, 315 ask. So let's assume we bought that call option. Facebook stock would have to close above 135 in this example, which was the strike price of the call that you bought, or you would incur a total loss of the $315 premium. So I think Facebook's trading around 119 right now. So that just gives you an idea of the risk you face when you're trading options. And here's a daily price chart of the S&P 500 index over the last couple of years, and you can see a lot of volatility here, very little trend. So when you're making directional trades and use a money management system like we do, it's easy to get stopped out with any of these sell-offs that you see here in the stock market. So that's what we're up against with as option traders. But option spreads, on the other hand, can profit if the underlying stock increases, decreases, or is flat. So we'll look at a little-known option spread strategy today that can eliminate risk totally if you're able to set up this option spread, which we do on a regular basis. And this option spread strategy's been performing very well this year, despite the volatility and the sector rotation. And once we set this spread up, then we're guaranteed to have a profit for our option trade, and we can forget about everything else. So I'll show you how we set these up today. So we use what we call our prime trade select system to select option directional trades, and there's a Metastock module available for prime trade select that will do this for you automatically. And once we enter an option directional trade, then we have 3 simple rules to manage the trade. The first rule, of course, is we exit losing trades quickly before they turn into large losses. And the other rule, the other side of that is we don't want to exit winning trades with a small gain, because that's bad portfolio management, and I'll show you some examples, recent examples of that. And then we want to use options to protect profits with winning trades. So if we have a winning directional trade, then we want to use options to protect those profits. And that's especially important in this type of market environment where you have a lot of volatility, very little trend, very hard for directional traders to make money. So we've developed this option spread strategy over the years, and it really works out well in these kind of markets. So we're going to show you we have $1.9 million in closed trade profits over the last several years, and I'll show you those trades. And these are trades that were selected using Prime Trade Select, and then it also includes the option spread strategy trade. So the combination of directional trades and spread trades, we have $1.9 million in actual closed out profits, and we also have $1.2 million in open trade profits, average return of 177%. So just as a general background, the optioneering team has over 60 years of combined trading experience. We started teaching option strategies to other traders over 20 years ago. I started out with just a $4,600 trading account, and during my first 2 years, I made over $460,000, which was more than I made the previous 6 years as an airline pilot. So these are just my tax returns those first 2 years showing my $460,000 in profits from trading options. And the optioneering team has received a total of 13 World Trading Championship trophies, and we have 8 first place, 4 second place, and a third place. And I've won the World Trading Contest 8 times, which is more than any other trader. Last year I took first place with a 309% real-time return in the World Trading Championship. That's a real money contest, and the results are audited before being posted on the sponsor's website. So the year before I took second place with a 339% return. So I'm not trying to brag with our actual results, but I just want to build your confidence in the strategies, because you're actually learning from somebody that's in the trading trenches every day. So let's move on to our Prime Trade Select. This is our system we use to select directional trades. First step is we want to determine the price trend of a stock, and we use the 50 and 100-day exponential moving average system. The second step is to select a low-risk entry point using the Keltner channels. And then the third step is we use what we call the 1% rule to select an option strike price with a high probability of success. And these are just, that's a very basic rule of thumb, but if you use that when you're trading options, I think it'll really help your percentage of wins and really improve your performance by simply using this 1% rule to select the option strike price. So step one is we want to determine the price trend of a stock, and we use an EMA trend following system to determine the price trend. And the goal of the exponential moving average system is to quantitatively measure the buying and selling pressure of the stock. And if we're trend followers, it allows us to follow the trend instead of trying to predict the trend. And of course, with trend following, you use a system and instead of making emotional decisions. And we've been using trend following successfully for more than 30 years. And it also, our trend following system worked well in the 2002 and 2008 bear markets when we were heavily short most markets during those bear markets. So Prime Trade Select works both ways for both bullish and bearish trades. So a stock is on a buy signal with our trend system if the 50-day EMA is above the 100-day EMA, and a stock is on a sell signal if the 50-day EMA is below the 100-day EMA. So pretty simple system. And if the stock is on a buy signal, then of course we purchase the stock or call options. And if the stock is on a sell signal, then we purchase inverse ETFs or put options. And as I mentioned, this trend following works in both bull and bear markets, and we were heavily short most markets in the last two bear markets. Okay, let's look at an example of a buy signal using the EMA system. This is a daily price chart of Cigna stock, and the red and green vertical lines represent the daily price movement of Cigna stock. And this blue line right here is the 50-day exponential moving average. The red line is the 100-day exponential moving average. So we can see the blue line crossed above the red line right here. So when the 50-day crossed above the 100-day, then the stock was on a buy signal. And as long as the blue line, the 50-day, remains above the 100-day, then the stock is on a buy signal. So that's an example of a buy signal. Here's an example of a sell signal. Daily price movement of the China ETF, and you can see that the blue line right here, the 50-day EMA, crossed below the 100-day EMA. So right here, the FXI, the China ETF, stock ETF, was on a sell signal right here when the blue 50-day crossed below the 100-day. And as long as the 50-day is below that 100-day, then the stock is on a sell signal, and we want to take bearish positions. And step two of our trade selection is we want to find a low risk entry point using the Keltner channels. And the Keltner channels act as an overbought, oversold indicator. They're similar to the Bollinger Bands, and this is a daily price chart of Home Depot stock. The red and black vertical lines here are the daily price movement, and then overlaid over the price movement we have the three Keltner channels. There's the upper channel, this blue line right here, the middle channel, which is the dotted line, and the lower channel, which is this blue line right here. So we want to use this to help time our entries into directional trades. So when the stock, this is the daily price movement here, when the stock is trading up near this, the upper channel, it's getting overbought. And normally when it gets overbought, then it retraces, and we want to wait for that retracement before we will enter a trade. So we look at stocks that are on a buy signal with the 50-day EMA above the 100-day EMA, but before we pull the trigger, we want to make sure that the stock is not overbought, because usually when it's overbought, it's going to retrace. So what I did is I circled the instances where the stock was becoming overbought, where the stock was actually trading above the upper channel. So you can see overbought, sold off, overbought, sold off, overbought, sold off, etc. So you can see that when the stock gets overbought, the odds are it's going to retrace, and you don't want to buy it when it's up near this upper Keltner channel. So we wait till it retraces towards the middle channel or the lower channel and becomes oversold before we enter the trade. And you can see when it does get oversold, then it normally normally rallies. So oversold rallies, oversold rallies, oversold oversold rallies, etc. Oversold rallies. So we like to focus on stocks like Home Depot that uh, stay pretty much inside the upper and lower channels and are very predictable. They have very predictable price moves. So this is an example of the kind of stock where we want to trade, because you can see it's very predictable price pattern. When it gets overbought, it retraces, and when it gets oversold, it rallies. So let's look at a couple examples of these are actual trades that we selected using the Keltner channels, and notice how the stocks rallied after we purchased our call option, and these went on to be profitable trades. The first example is for Amazon, and we can see Amazon was in a strong price uptrend, and the question is, when a stock is in a strong uptrend, when do you jump in? And of course, we wait for a retracement with the Keltner channels before we actually purchase an option. So in this example, the stock was trading, it got overbought right here, and then it retraced to the middle channel. So right in here, when it was trading at the middle channel, we bought the January 330 strike call at 113. And then you can see after our entry, the stock did rally. So using the Keltner channels did, in this example, allow us to get a low risk entry because the stock really didn't retrace. Here's another example. This is for Starbucks stock. And again, we can see the daily price movement here. And this is in a strong uptrend. And the question is, when do you want to jump in? Well, we waited till it retraced right here, and then we bought the 40 strike call at 1375. So in these examples, the Keltner channels allowed us to get a low risk entry because the stocks didn't really retrace much from our entry point. And of course, when you do that, then that helps prevent getting stopped out of the position. And then the third step in our trade selection is we use what we call the 1% rule to select the option strike price. So once you decide you're going to buy a call option, then there's hundreds or even thousands of strike prices to choose from. So selecting the strike price is just as important as the trade selection itself. And option premiums consist of time value and intrinsic value. And of course, options lose all time value at option expiration. So when you buy a call option, just remember you're buying a decaying asset, and each day the time value of that option is going to decrease until you get to option expiration. Then it will be at zero. So due to these time decay characteristics of options, we want to minimize time value and maximize intrinsic value. And the way we do that is we limit the time value portion of an option to less than 1% of the stock price to minimize time value and maximize intrinsic value. So as an example, let's say we're going to purchase a call option and the stock is trading at 100. We want to limit the time value portion of that option to 1 point or less, which would be 1% of the stock price. So if you're able to limit the time value portion of an option to 1% of the stock price, then the stock only has to go up 1% in order for the trade to break even and to start profiting. So if you use this 1% rule, your trade's going to have a much higher probability of being profitable than selecting an option strike price that requires, let's say, a 6 to 10% increase in the price of the stock just to break even. So when we use this rule, stock only has to go up 1%, and we break even and start making money. So we use the 1% rule for all option purchases that we make for directional trades, and that only requires a 1% increase in the stock price to break even. So let's look at an example. This is for the DVY. That's the Dow Jones Dividend ETF, and we bought the DVY 70 strike call at 1170. Now, at the time, DVY was trading at 81.38. So if we buy the 70 strike call, that's going to be an in-the-money call because the strike price of 70 is less than where the stock was trading at the time. So with DVY stock trading at 81.38, if you subtract the call price from that 81.38, you get intrinsic value of 11.38 for this option. And if you take the total option premium, we bought it for 11.70, and you subtract this intrinsic value of 11.38, you come up with the time value. So the time value portion of this option that we purchased at 11.70 is only 32 cents. And what that means is DVY only has to go up 32 cents, and this trade will break even and start making money. So this is an example of one of our option calculators. We have 6 different calculators that will calculate the profit potential for an option trade or a spread trade before you take the trade. And the way these calculators work is you plug in the stock price, the strike price of the option, and the price you paid for the option, and then you can put in various changes in the stock price, and this calculator will calculate the profit potential at option expiration, assuming these various price changes in the underlying stock. In this example, from a 30% increase in the stock to a 5% decrease at option expiration. So in this example, we bought the 70 strike call at 11.70. So let's say the option was flat at option expiration and it was trading at 81.38. So this call option, if the stock was flat at expiration, would only lose 2%. So that's a lot better than purchasing an at-the-money or out-of-the-money call, and if the underlying stock is option expiration, then you lose 100% of the premium if it's not above the strike price. So in this example, you can see if it's flat, we do take a small loss, but it's not catastrophic.